Welcome to the weekly update, where I'll go over the action in the market for the week of September 16th through the 20th, and then we'll see how things look for the week of September 23rd through the 27th. I'm recording this a little bit earlier than usual. Right now, as I record this, I'm traveling and I want to go do some touristy type things. And so some of the charts from Isabel Net, the blog that I like to go through and go through some of those charts, those have not updated yet. So I won't be going through that this time, but I do have the charts that I put together and show you to present. Now, we had another up week and the Fed came in, they cut interest rates 0.5% or 50 basis points. And there was initial kind of gyration, a little bit higher, a little bit lower. But then we saw a big update on Thursday. Now, Friday was pretty much flat to slightly negative, but that was what we call quadruple witching. Some people still call it triple witching. A number of different option contracts all expire on the same day, and that can produce a pretty crazy day where we see a real spike up in volume, but we didn't really see much in the way of price action. Now the S&P is dealing with the 5,700 level. It did set a new all-time high this past week. The Dow set a couple of new all-time highs, specifically on Friday. That's the latest one. So we're looking quite positive. But at the same time, there's a couple of negative things hanging out in the background. It's called a Hindenburg omen, and I'll show you that chart. And then we have a potential period of quite weak seasonality, especially after this option's expiration. As we finish out the month of September and go into October, historically, the market becomes quite weak. We're not seeing really any confirmation of that in our charts, and we won't drift over to negative until we do see confirmation in our charts. But we just want to be aware of that nonetheless. Just to let you know, I do videos every day. I do these weekly videos. If you really want to know what's going on in my analysis and commentary, please watch the daily videos. That's where you're going to get the most use out of the approach that I use for analyzing and providing insight about the markets. I do have a PDF below this video and every video that I post that you can download and look at. I do update pivot points every day on the YouTube community tab. I can't do that on Rumble. There is one chart that the pivot point is good for the whole month, but I update it as each day passes. There's another pivot point chart that only applies to that particular day. I do have a private Facebook group. If you're not interested in the program that I have, you can join that group. Not really active, not a lot of members, but you can always join that and change it if you want to. It's a way to have contact with me, and I'll answer your questions, or we can have a back and forth about something if you want to do that and you belong to Facebook. I do really watch YouTube and Rumble comments. I've been getting a lot of these social media experts who come in and don't watch the videos, but still say what great videos they are. And they tell me how they're going to just make life worth living. I delete those comments right away. Now, if it's a legitimate comment, I have no problem with that. But the spam and the crap comments, they go away as soon as I see them. I do post on both YouTube and Rumble. Now, where I'm at right now, my download speed is great, but my upload speed is pretty slow in the hotel that I'm at. So it takes me a while to upload these videos, but I do post to either YouTube and Rumble. You can check me out on either platform. I do have a program. It's called the SPXInvesting Program. It's up, it's running. There's a link below this video that will take you there. There's also a link to a video. You can learn more about that. And there are additional videos that I post there that I don't post on YouTube or Rumble. And members have access to the daily videos. As soon as they're prepared, you can watch them. And the weekly videos that I do, where I delay making those public on YouTube and Rumble. So feel free to check that out. It's free right now, but I'm going to be locking that down at some point. It's supposed to be a membership type program. I've just kept it open mainly because I'm traveling right now and I didn't know if I was going to be able to even do these videos. Here is just a graphic to show you how the daily video is the real foundation of what I do, and all the videos around the outside are weekly videos. Okay, let's go back and talk about what happened this past week. We were up 1.36% on above average volume. Now, the big update that we saw on Thursday, that was pretty healthy with volume. Not much above the moving average, but it was above average. The big spike came on Friday when it was quadruple witching. we are looking positive now. The longer term is doing okay. And so we'll show that as we go through the charts, but we're looking really good in the short, intermediate, and long term on the daily charts as well. But we're worried about this weak seasonality. We've seen this Hindenburg Omen. The perma bears are already salivating over this, thinking, okay, the stock market's going to be over as we know it. If anything, it looks like it could be a pullback because we still have a pretty positive backdrop for right now. But that could always change. Something could happen. Economic reports come out, a black swan event. We always want to be prepared for those things. And even if we're positive right now, I really, really stress the idea of hedging in your long-term portfolio and even shorter term as well, so that you can benefit when you buy low and sell high, you make money. But if it goes against you, you break even. You're not losing anything at that point. This past week, we did have a cut in interest rates because inflation seems to be coming under control. We want to be aware of the geopolitical things going on, especially if they impact the stock market. And really, they haven't had much of an impact lately, but that could change too. And then I'll go through some of the Fed speak that went on this past week. We are still in a weakening trend, but it's positive. The green line's above the red line, so we still default to positive. We just switched over to a non-confirmed positive trend on the daily charts. So here's some bullet points. The stock market ended up having another strong week pretty much across the board. The Fed did come in and cut rates by 50 basis points. There was one Fed governor who opposed that. That Governor Bowman wanted a 25 basis point cut. And then they come out with this directive. Just here's what we think is going to happen. This is what we're doing right now. The committee said it has gained greater confidence that inflation is moving sustainably towards 2% and judges that the risks to achieving its employment, that's what we're watching now, is employment, and inflation goals are roughly in balance. The market liked that. And then they come out with another report called the Summary of Economic Projections. It showed a shift in the median estimate for the 2024 employment rate. They're actually bumping it up to 4.4%, where it had been at 4% the last time they met. Then they downwardly revised the PCE inflation. We're going to get another report this upcoming Friday with PCE and core PCE. They actually brought it down to 2.3%, where it had been at 2.6%. The market liked that. Core PCE came down 2.6% from 2.8%. And then they have this thing called a dot plot. It shows the median estimate for 2024, 4.4% for the Fed funds rate. That implies another 50 basis points of rates this year and another 100 basis points in 2025. And the market liked that. But then you have this thing going back and forth. And watch the daily videos to get better context for this. There are folks out there that say once the Fed starts cutting rates, the stock market is toast after that. And sometimes that's true. There's also other times when the Fed cuts rates and the market likes that. It depends on the context. Right now, the context is positive. They're cutting rates because inflation is under control and they're trying to just kind of fine tune the economy to do a little bit better. Other times they've had to cut rates, it's because of 9/11 or the great financial crisis or the COVID lockdowns. That's a black swan event. That's something really negative that's hitting the market, and stocks go down anyway. So we have to know what's in the background. We're still going with this more rosy scenario for right now, realizing that that could change. There's a lot of crazy things going on right now. And one of those crazy things could have an impact on the U.S. economy and also have an impact on the stock market. Then at the press conference, Fed Chair Powell, he said, no, 50 basis points, that was proper. It was to recalibrate, to make sure the labor market and the economy remain in solid condition, and that the intent of the more aggressive move is to make sure that they remain there. He also said that the Fed doesn't feel like it's behind the curve. They always are behind the curve, but they're always going to say they're not. And you will only know this in retrospect anyway. And that a larger rate cut can be considered as a sign of the Fed's commitment to not get behind. That's why they cut 50 basis points instead of 25. And now the speculation is, well, why did they do 50? That's double what usually happens here. The other times they've cut 50 basis points, that was before the dot-com crash. That was after 9/11. Actually, it was after the dot-com crash. That was as we were going into the great financial crisis and into the COVID lockdowns. For right now, the context is different. So we'll have to see if that changes going forward. And then the economic data coming out. We're not falling apart with employment, at least yet. And the economy is growing. We have positive GDP right now. And that supports the idea of a soft landing without going into a recession. But that could change. And I do extra videos, not maybe once a month, every month and a half, just to do an update on how is the recession outlook going. And I put those on the website. And Friday was quadruple witching. That means we saw this explosive surge in volume. And then I want to warn you here, and I'll have charts later on to show this. We do have a confirmed Hindenburg-Ullman. It triggered once, then it triggered twice. That means it's now confirmed. And we do see a period of historical weak seasonality coming up. Okay, so here is how we looked for the week. The Dow was up 1.6%, closing at an all-time high. The NASDAQ up 1.5%, not near its all-time high. That's a little bit of a negative divergence there. The S&P was up 1.4%. It did set an all-time high on Thursday. And the Russell has a long ways to go to get back for small caps to get to their all-time high. They're just bouncing around in the range right now, but they were still up 2.1%. After being down over 1% on Friday, they were still up 2.1% for the week. And then I've been showing this for about a year and a half now. This is the blue line where we're coming down with inflation to see, okay, what's going to happen after this? Are we going to see this massive move up in inflation like we saw back in the 70s? Or are we going to just continue to go down? We're going to go sideways? We don't know actually what's going to happen. We just want to be realist about this whole thing, watching things as they happen, watching the geopolitical events and the economic reports. And then as they see this shift going from one scenario to another, we will adjust accordingly. We are coming in at 3.74% with the 10-year yield, which is below the 4.02%. That's helping corporate profits to do a little bit better. We don't have an update of this. We won't get an update of this chart until the next employment situation report comes out. This is the only chart here that I have from Isabel Net blog. It just shows how earnings are looking positive going forward, which still supports the stock market going up. And then we go to FactSet. They had a post here. It says less than 50% of the companies cited inflation. These are companies inside the S&P. And you can see a chart where they're still talking about inflation, but it's really coming down. We're also seeing how it's coming down on these other two charts here. Then looking at the intraday chart, we were pretty quiet on Monday and Tuesday. We did end up, going up a little bit here, but the market was really poised for what in the world's going to happen on Wednesday. We were pretty quiet then. And then here's the gyration that happened after the Fed made their announcement. And we actually ended up closing lower. But then during the night, the S&P futures got very strong, up over 1.5%, almost up to 2%. It came down a little bit by the time we opened, but then that produced this really big gap. And we didn't really see much movement after this. Now, what I've been warning about in the daily videos and to the members in the program, we want to be careful of something like this. You see how back on Tuesday, we gapped higher and then went lower after that? This can be called a bull trap, basically, where you see a huge gap up, we start seeing selling into strength, the gap gets filled, and then we just keep going down. It didn't play out that way on Thursday, but we need to be aware of these things. We get focused on confirmation bias where we just want to see what we want to see. We still have to allow for the three scenarios, up, down, sideways. That has to be in our mind all the time. Well, we came back down a little bit, but then we were able to get back up. This is where we set the intraday all-time high, and then we set the closing all-time high here. Then Friday with quadruple witching, we actually spent all the day, pretty much. We tried to peak up positive here near the end of the day, but we closed just a little bit below the daily pivot. So it was a positive week for stocks. So looking at the week, just for the indexes, the NASDAQ and NASDAQ 100 were up the most, and we had the S&P down here in pink. It did well, but all the indexes were up. This is going back to the beginning of the year, where now we have the NASDAQ and S&P. A week ago, the S&P was in first place. The NASDAQ is in first place now, but another concern. You notice the NASDAQ 100. These are the mega cap stocks. It's now gone into third place. For most of 2024, it's been in first place. So we're seeing a little bit of a shift there. Doesn't necessarily mean the market's going to fall apart. It just means it could actually be positive in that it's not just a few stocks that are really driving the market higher. We're seeing them spread out across the market more. And that's helping the NASDAQ and S&P 500, which are broader market measures than the NASDAQ 100, to actually perform better. But now all of the indexes are positive year to date. Looking at the sectors, we had an up week. So we had energy and financial, which is doing good, and we want it to do good. But this time back in 2007, it was also doing good. And then we went into the great financial crisis after that. Communication, another growth area. Discretionary, a growth area. We want these to do well if we're going to go higher. And then real estate, which has been doing well lately, it ended up being down with staples and health. Now, health and staples, these are defensive areas. We've been watching this. When the market's getting ready to go down, healthcare and staples tend to really do better. And when they start to outperform, and you could also put utilities in that group as well, then the market is getting more defensive, meaning that it's poised to decline. Well, it didn't happen this week, but we've been watching this happen now over the last couple of months. And so we've just been keeping an eye on this because this is what happened. We saw staples and healthcare doing a lot better going at the end of 2021, right before we went into 2022. Then I sort this in a different way. Which sectors are looking the strongest right now on a score of 0 to 100? We still have utilities and real estate. Again, you could make a case for these being defensive. And then they're in the 90s, where we still have financials, discretionary, and communication in the 80s. We have energy down here not doing very well, even though it had a pretty good week. Then looking at just the 5 trading days for how the sectors did, we had energy, discretionary, and industrials, as well as tech, being positive. The rest of the 11 sectors were negative. This is going back to the beginning of 2024. Utilities are still the strongest area, followed by communication and financials. All the other sectors, according to, because I measure this a little bit different. I don't include the S&P. You see where it's blacked out here. And so they're actually negative year to date. We look at the relative rotation graph. These areas up in the top right, real estate and utilities. We're also seeing healthcare, financials, and staples. These are more defensive areas. These are the areas that have been performing better. We just want to be aware of that. We're not seeing confirmation of that, but this is quite often what happens before the market gets ready to decline. But we're not seeing it yet, and we'll wait until we do see it, where we see tech and energy actually showing some weakness, with a little bit of strength coming back into the communication area. And this is what they look like more on a spreadsheet form, with real estate, utilities, healthcare, financial, and staples doing the best. More neutral now are this blue area here, where energy and tech are the weaker areas. And this goes back over the last year. Then we look at the different indexes, where we have the utilities doing the best, small cap showing an improvement, the Dow Jones Composite improving, where we're seeing the NASDAQ 100, that's actually getting weak now. The S&P 100 and the S&P 500 are showing some weakness over the last year. We are seeing an improvement in the mid caps. They like the fact that interest rates are lower as well, and a little bit of improvement here from the transportation index, which has been a real disappointing area in 2024. This is what they look like in spreadsheet form. The green areas are positive. The red area, we have the NASDAQ 100, not looking very good over the last year. Sentiment, just to get, this is kind of for fun here. This is people that can actually bet on who they will think wins. And I took this screenshot right before I started the video. Looking at sentiment this way, where we're in the positive area. Now they call it greed here. I say it's positive until we get above 75, if we even get that high. Where lately we've been more neutral. Well, with the big up day, we saw a real increase in sentiment. And this is what it looks like, where we had been coming down. We tend to go with this until it gets to an extreme negative or an extreme positive reading. but it had been coming down, so we were more negative. Now it's starting to go back up, and we've switched back to looking more positive. The active asset managers coming in with a pretty high reading now, but not necessarily extreme. Here's another chart. We came in at 87.46, just under that 90 level. That's where they're getting a little too exuberant, and it could really bump up in the next reading. The Ulcer Index is still below its moving average here, and this is another fear gauge. We did decline overall for the week with the line chart with the VIX and the bar chart of the VIX. As we've been going up, the VIX has been going down. But seasonally, this is what we're concerned about. The VIX has the tendency to really start going up. Hasn't really done that yet. And we're coming into another weak seasonal time for the S&P. If it does start to go down, then the VIX will start to go back up. We look at the Ridex bear bull ratio, and these poor folks, they're ping-ponging just in the wrong direction. We have a big down day, so they get in the bearish fund. Then we have an up day, they get in the bullish fund. Then we have a down day, and they get back in the bearish fund. And they're just doing the wrong thing at exactly the wrong time. But we use this as a sentiment gauge. They're actually kind of bearish right now with their reading. We're looking pretty good here. This is another sentiment gauge showing that the tech sector, as this black line's going down, that means it's outperforming cash. The latest reading from the American Association of Individual Investors is coming in pretty positive now, but not necessarily extreme. And we want to keep an eye on the risky versus non-risky bonds. And that's what we measure in this chart. But then on the next chart, this is an inversion of that same chart. This going up, that's actually good. That means there's less fear coming out of the market. When this really drops, that means fear is increasing. And then just to give it a little bit more context, I put the S&P on top and the VIX on an inverted scale on the bottom. We look at the VIX and then the 3-month average of the VIX. It's continuing to go down. That tends to be more positive for the market. We're also declining with our 253 period simple moving average of the equity put call ratio. And then economically, we're still under this black line with the latest reading of the national financial conditions. That's positive. And GDP coming in a little bit under 3% now with the latest reading. When you look at the different economists, we're anywhere from about 2.5% to the upside to 1.5% to the downside. And we will get another reading of GDP this week. It's just the third estimate right now. And this is also looking positive going forward. The takeaway from this is all of these bars looking out, all of these black diamonds are positive. Also, we're seeing positive bars here on this chart, and that's good for the time being. This is something that was updated earlier in the month. This will be updated again when we get the next employment report. We're a bit above this red line, and that could be negative for the market. And the perma bears love this chart. But we're looking okay here with the smooth U.S. recession probabilities, but that hasn't been updated now for a while. And this is a quarterly chart that hasn't been updated in a while. It's still not really showing anything that drastic. And we're kind of adjusting a little bit here with inflation. We did get CPI that came out earlier on. We're going to get core PCE coming out at the end of the upcoming week. Okay, so now the September meeting is done and over with. Now we start to focus on the November 7th meeting. And there's not a big split between, okay, is there going to be another 25 basis point cut or another 50 basis point cut here? And this is how things have adjusted. I don't spend a lot of time on these now because we still have a long ways to go. And then we also look out to the December 18th meeting and where folks are thinking interest rates will be. And this will change many times along the way. The balance sheet continues to go down based on the chart. It's going up based on the latest reading. Only a government chart can do that. And then we're looking at this going up and actually going down here, but that's it. This is the year over year basis for the Fed balance sheet. We want to watch this just to see if it starts moving in one direction or the other. And it's really not doing anything right now. And we're looking good here with the advanced decline line. Based on price and volume, they're above an advancing moving average. That's positive. We did see more new highs than new lows, coming down a little bit here, but we're going up with the 4-week and we're flattening out here with the 10-week moving average. We declined, but we're still positive with the advanced decline ratio. We're looking positive here longer term. This is a weekly chart of accumulation distribution, which is a smart money indicator because it takes price and volume into account. We're looking pretty solid here. We were showing some weakness on the daily chart. Now it's starting to show some improvement after Friday. We'll see if there's any more follow through with that. Then the condition of the trend, where we have the green line going up, the red line going down. I know it's hard to see. That means we default to positive, but the red line or the ADX is below the moving average and both are declining. That suggests a weakening trend, but we still default to positive, but we're still trending since we're above 20. Then we look at the Arun, which is positive right now. It measures the green line from the red line, buyers versus sellers, and it's above zero. So that's positive. Now, this is interesting. We had a mass index signal a few weeks back on the daily chart. We're setting the initial trigger here on the weekly chart. If we go up above the blue line, it's going to take a few weeks for this to play out. And then we come back down below the red dash line. That's a signal, and that signal, and that's supposed to signal a reversal. It seemed to be valid, even though it was quite delayed with the daily chart. We'll see if this one ends up turning into anything. Long term, this is a daily chart right here. We're still looking pretty solid, just coming off of setting an all-time high. You can see Friday session had this massive influx of volume. We're positive on the short, intermediate, and long term with the Keller market model when we look at the S&P, mid caps, small caps, and the NASDAQ 100. We're positive with the commodities, and I'll show you a chart of that here, but we're negative in the intermediate and long term. We're still negative across the board with the dollar. We're still looking good here with the trend channel. We haven't hit this upper band yet, and we're still above the midpoint. That's hanging in there quite well. I've been showing this in the daily videos. We're above this R2 pivot level. And now, looking at the S&P based on a trending basis, we're looking positive. We're above an advancing moving average, and the red line, which is the moving average, is still going up. Then this chart is a moving average crossover. Both lines are going up, and we're above both of those lines. That's positive. And we actually declined a little bit, but we're still above zero with the McClellan oscillator. The bullish percent index, we're getting a little concerned about this. We're seeing the same reading on the daily and weekly charts because this is a different kind of indicator. A lot of times when we get about around this level, that can mark a top in the market. Now, it could still go up a little bit from here, but we want to be aware of this. And we're getting extreme with the summation index based on price. We're looking positive here based on volume, but not necessarily extreme. And we're going up with the Swenlin trading oscillator based on price. We actually declined a little bit here based on volume, and we're concerned about that. On the daily chart, we're positive, but both price and volume are now going down. Look, as far as momentum, trying to turn back up with the PMO, we were up based on price and volume here. So we actually declined a little bit with the PMOs that were rising over the last week, but we're still going up with the buy signals, and we're going back up with the PMOs above zero. We're up at the upper end of this Bollinger Band here, but we haven't exceeded outside of it at least yet. That's positive since we're above the midpoint. Now, the momentum, though, we're looking more negative here, we're kind of all over the place. Where we switch back over to positive on the daily charts now, we're actually still looking a little more negative to neutral here. Some of these lines are trying to turn up, but some are still going down. Chaikin money flow, we have been declining on the daily chart except for Friday's session, but we're still going up here on the weekly chart. Chaikin oscillator, declining on the daily chart, but still going up here on the weekly chart. We're positive with the force index. We crossed back above 50 with the money flow after going negative. And we had an up week, but it was less than the previous week. But this is positive for the rate of change. And we're continuing to go up here with our 50-week rate of change. We're coming out of being extreme negative with the Stochk RSI, but we're still below the midpoint here. And we're above 50 and going up with the RSI based on 14 weeks. And we're still negative. We're below this red line, which is a moving average. With the weekly special K, the daily special K continues to be positive. And we're getting extreme positive here with the Williams percent R. And we're above 50 and going up with the ultimate oscillator. The vortex has the green line above the red line. That's positive, and we're going up with the green line. And we're positive with the Copic curve on the daily chart. We're still negative on the weekly chart. And we're above all these other support areas that we might be looking at. On a trending basis, we're still looking good here with the Heiken Ashi showing open candles. That's positive. The Kegi is still pointing up. That's positive. The Renko chart has open blocks. That's positive. The three-line break is positive. And the ease of movement is still above zero, where we just went back above zero with the ease of movement on the daily chart. And we have some new X's drawn in here since we went up and set an all-time high. This is calling for a triple top breakout, which was generated back on last Monday on September 16th. This is a 50-day cycle. Not sure how relevant this is. We did have one start August 19th. We're kind of midway through the cycle now. Looking at our longer term momentum studies here, we're pretty much flat in the long term, going up in the intermediate term and up in the short term. And we're looking positive with the Elder's Impulse system for the weekly chart of the S&P and the parabolic SAR chart. It's positive here on the weekly chart, and we're positive on the daily chart. Broad market measure setting an all-time high with the S&P, have a ways to go with the mid caps, and the small caps still continue to just bounce around in their 2024 range. Seasonality, we were showing 0 down here a week ago. Now with the up week we just saw, now September tends to be pretty bad for stocks, and that's the month we're on right now, but there could always be an exception. We're not going to assume anything will happen. We have to let the data tell us if things are changing. The Dow is positive and setting an all-time high. The NASDAQ is positive, but not near an all-time, or it's not too far away, but not setting an all-time high. The NASDAQ 100 weekly chart is looking back positive again. The mid caps are positive. Small caps are still positive. The NYSE setting an all-time high. The Wilshire came off of setting an all-time high on Thursday. This is a daily chart. The biggest software companies finally showing a little bit of upward movement here. The FANG index back above the 13-week moving average. That's positive. All stocks back to looking really solid again. ARC just kind of going sideways, still in a downtrend here on the weekly chart. And the banks looking good. We want the banks to do well. If they're not doing well, that might mean things are going wrong in the financial sector. We're above 50 with the RSI, we're looking pretty solid here with the bars, and we're just kind of chopping around and slightly negative with momentum. And we're seeing some money recently coming out of banks, but overall, folks have been having the confidence to put money into banks. This is a weekly chart of Dow theory, setting an all-time high with the Dow, not even close with the transports, and close, but really not really setting a new all-time high with the utilities. Commodities, we just started to see a downtrend here on the weekly chart, but then they ended up being up over 3% on the week. Oil dropped below 70, and now it's back above 70. We're keeping an eye on this for geopolitical reasons, basically what's going on in the Middle East. Gold is setting an all-time high based on the ETF. And here's the dollar, which is in a downtrend right now, and that's actually been supporting stocks. Copper is bouncing up off of its 200-week moving average here. That could be positive for copper as well. And then silver, not setting an all-time high, but still in an uptrend. And then we look at bonds based on price, looking really good right now. And the monthly chart of the stock to bond ratio, we'd come all the way down to the moving average a week ago. Well, now we're not down quite as much because it takes a whole month for this chart to complete. And here you can see where interest rates have been going down, but we did pop back up on Friday. Weekly chart where we're seeing an overall decline in the US, UK, Germany, and Japan. And then an intermarket analysis chart where we still have gold doing the best, followed by stocks, then oil, then we have the dollar, and then bonds based on price. So all these different asset classes are now positive year to date. We look at a ratio between the NASDAQ 100 and the S&P. As the NASDAQ has been underperforming, the S&P has really been doing better. That's why we're seeing this ratio going down. The S&P 100, which was really leading things higher, has now fallen back, but still in an uptrend compared to the rest of the S&P. Growth versus value, we want growth to do well. It came down to the moving average, and so far has been able to bounce up off of that one compared to value. And not seeing a real big shift here when we look at the gold to S&P ratio. Bonds continue to underperform stocks, at least according to this chart, even though bonds are doing quite well. Longer term, they're still underperforming. And gold to the dollar, gold has been going up as the dollar's been going down, so we're seeing a real breakout of this ratio. And then low volatility stocks, which are more defensive. If the market's getting ready to go down, we would see this going up the way we were. Well, it did fall back, at least in the latest week, and longer term, it's still in a downtrend. Discretionary, this is the things that make life fun, tends to be more of a growth area compared to staples like toilet paper and toothpaste. We are still in a downtrend with discretionary to staples, although it did bounce back up in the latest week. Energy to tech shows how energy is underperforming the tech sector. And then we look at small caps to the tech sector. When this is going down, that means the tech sector is outperforming. When this goes back up, that means small caps are showing favor. Small caps are doing a little bit better here, but they've got a long way to go to get above these moving averages and then see the overall trend change. We haven't seen that yet. Long-term chart of the NYSE breadth thrust looking pretty solid here. Now, we did get a couple of extreme readings this past week with the ZWAG NYSE breadth thrust, but these are not official signals because we did not drop down below the 0.4 level. But just the fact that they're giving these high readings, that's positive in and of itself. And then the next chart just shows you all the ZWAG NYSE breadth thrusts and what their results are, usually looking a lot more positive the further out you go. We're still looking good here with our long-term weekly chart. We're still on a full-on buy signal with the Zohorchak method. We're still above this trend line going back to the 87 crash. And the NASDAQ 100 is still above this trend line going back to 2009. We're still going up with the 50-period moving average of the new highs, new lows for the S&P. That's positive. And we're going up with the NYSE new highs minus the new lows. So the broad market and the broader part of the S&P 500 is still doing quite well. And we're right up around this blue line here with our Qs to small cap ratio. The NASDAQ 100 to Dow ratio still right around this very high reading. And we're pretty much flat now with the cumulative new highs, new lows for the NASDAQ. But we're looking positive here with the new highs minus the new lows. And this is something, and I talked about this in the daily video because we're watching this chart now. We're rolling over and coming down. We also rolled over and came down back in 2007 into 2008, which was the great financial crisis. Now, the doom and gloomers, they're already declaring that we're going into another financial crisis. And that might happen. But right now, the context is different. This is more, the Fed is cutting rates and rates are going down to try to stimulate the economy. The economy is not necessarily falling apart. And so we're not going to necessarily head into a recession. But all of that is subject to change. The context can always switch. Right now, it's more positive. It could switch over to being more negative. And that's why I say, watch the daily videos, because I really keep up with this stuff in those videos. And then here's the Hindenburg-Ullman. If you don't know what that is, here's the definition. There are 3 criteria that must be met for this to be valid. And here's the actual chart where we saw the initial spike on September 5th, and then we saw a confirmation spike on September 12th. That's valid now. And you can see, why do we pay attention to this? The last time we saw a series of spikes, that was right before the COVID crash. The other time we saw a series of spikes, that was at the end of 2021 going into 2022. So is it going to turn into anything? We don't know. Now, I don't have the chart here, but the NASDAQ was giving signal after signal after signal and confirmation after confirmation, but we're still going up with the NASDAQ. Could this time be different? Of course it can, but we still want to respect this and see the other times when this really happened, that was a significant deal. Seasonality. Okay, this just breaks it down based on what happens every day of the week. Mondays tend to be the most negative. And let's see, Wednesday tends to be the most positive. And this goes back to 1928. This is the negative seasonal time that I'm talking about here. Now, this doesn't mean it'll happen this time, but historically, for the rest of September, even going into October, we do see some weak seasonality right about now. September tends to be the worst performing month of the year, going back to 1950. When you look at it on a global basis, not as bad as August, but still it's negative. And we had June, July, and August that were positive. Now we're coming into a negative time during an election year. And here takes September and October together, where they tend to be negative. Doesn't mean it'll happen this time, but it has happened before. And then we're coming into the second half of September now, which is the worst performing half of the month of the whole year. Again, it may be different this time, but it may end up being the same. So we want to just be aware of that. And then we saw weakness here in September as well as October based on this. And this compares both the S&P and the NASDAQ. They both tend to be under pressure in September and even into October. And here's another chart. See, I wanted to show a lot of different charts from different sources. I don't just latch onto one chart and run with that and make it my whole scenario. I like to use what I call the consensus approach, where I look at the weight of the evidence and say, okay, are all these different things saying the same thing? Because you might get one outlier here or there and you base a scenario around it, and then you're wrong. Well, we're seeing a lot of different sources saying the same thing here seasonality wise. Also negative from August through October when we look at this chart. And then this is during an election year where we actually tend to have a little bit more trouble, at least going into the latter part of October here. We're right now into potentially this time, and as we get into the middle to latter part of September. And then going back to 1950, we're up 9 times, down 9 times with a return of minus 0.4%. So thank you. I hope you found this helpful. I really hope you have a great weekend, and I will talk to you in the next video.